So I think one thing to note is, well, then what happens 5 years from now? Where will we end up? This most recent stat I thought was telling. 16 trillion, of course, is a big number. And I think the question becomes, how do we get there? If I were to give this presentation 5 years from now, I guess 6 years from now, would we really be able to get there? That's the question. I think we will. I think it'll have ups and downs. It'll be sinusoidal, but it'll very quickly become exponential at some point.
Alrighty, what is going on, everybody? Welcome back to another CYPRX video banger. In today's video, you all heard the gentleman at the very beginning of this video breakdown. His name is Thomas Cohen. We're going to jump into some video clips and some fundamentals via the developments that have been happening behind the scenes, showing you guys that now is not the time to be bearish on crypto and digital assets in this Web3 ecosystem. Really appreciate you guys for returning. Do us a favor, if you enjoy these deep dives, smash that thumbs up button and subscribe. Always attempting to keep you all in the loop, forward looking, and give you guys the realest research that never makes the mainstream. So we're going to listen to some video clips, and I just want to show you guys who you're going to be listening to today. And I'm going to share some tweets and my personal opinion on some of the things that he says in these video clips, but also covering some of the things that we've mentioned in previous discussions here on the CYPRX platform. For example, this post, we're going to full circle back towards where I said we are in the midst of a super cycle. Do not get caught selling too early based off of emotions and irrational thinking. As you all most likely have experienced and witnessed this most recent market downturn, we've seen a slight recovery in digital assets across the board. As of time of recording this video breakdown today, on the 8th of August, the total cryptocurrency market cap 24-hour trading volume has increased over $146 billion, or roughly up about 7%. From the Monday sell-off, the over the weekend sell-off, roughly Saturday, Sunday, rolling into Monday, the cryptocurrency market has rebalanced over $2 trillion in market cap, up about 21%, or gained about $357 billion in value, as you all can see on my screen. So just to reiterate back to what I mentioned to you guys, we know for a fact that financial institutions are interested in these digital assets. They will adopt them. They will utilize them for their personal benefit, to earn yield for their clients, so on and so forth. They're just waiting for regulatory clarity. We're going to cover that in today's video breakdown, okay? So don't miss a beat. Let's take a second and let's jump into some video clips from this gentleman just to show you guys his credentials, okay? He worked at the Federal Reserve. Let's go down and let's hit all of his experiences. This is his LinkedIn profile. He used to work at Ripple. He used to work at the Federal Reserve. You can see that here. He used to work at Morgan Stanley, used to work at Paxos, and now he is currently the vice president of tokenization at Galaxy. So he has some pretty reputable credentials. I would take into consideration what he has to say. So let's just roll the first video clip of this individual speaking on stage, and let's listen to what he has to say.
And I think we also have to really credit the industry as a whole in terms of how much better the user experience, how much better the technology, and how much better the underlying applications that we all use in this space have improved since the previous cycle. And so I think that's really one of the bigger differences here is just thinking back to 2020, the different apps we use on the DeFi side or on the institutional side, it's just very different. It's much more user-friendly and much more likely to make it easier for people to make the jump from TradFi to crypto. I also think that the regulatory side has begun to shift. I mean, as an American, it's pretty easy. I mean, I'm in Frankfurt here for many reasons, but one of which is we've seen so much capital flow to the EU because of MiCA and because of the power of it, and finally being able to be given rules of the road in a way that on the other side of the Atlantic, we're very much still deciding and in the discussion phase of creating the regulations that make sense for this industry. So it's very clear that while we have a long way, that progress is very much happening, and we see that as a large indication of the direction that we see this going. So that's all really what makes this year different from previous cycles. And I think it's important to note that I don't mean to indicate that from here it's all up and to the right. I mean, anyone who's been in this space long enough knows that it'll go down again. But what's important is that when things are going up, we go 2 steps forward, because we know that eventually we'll also go 1 step back.
So, how again could you be bearish on crypto? He mentioned that right now we are heading into an environment where there is a better user experience. We all know that a better user experience will enable mass adoption because the every average day individual that has no real understanding of the digital asset space, it will become very seamless and easy for them to integrate into this space as the applications become easier for them to understand, as the DeFi ecosystem becomes easier for them to integrate into, and so on and so forth. And this is also the same for financial institutions. We know that in previous market cycles, financial institutions weren't really educated on digital assets, nor the ecosystem as a whole, and as well, the infrastructure layer was not properly built. That is now all changing for the first time. This next bull market cycle, there is a lot of things to be optimistic about. The infrastructure and the ease of use of these new digital technologies is one of those things. He also mentions regulatory progress is happening. Now, obviously, of course, it's not happening at a pace in which we would all like it to happen, but that's not realistic. It is for a fact happening on a granular scale. Global regulations are starting to come into fruition, and over the next 1 to 5 years, we are going to see those developments unfold at a rapid pace. Last but not least, he mentioned that we could possibly experience another market downturn. Now, for my followers, okay, keep in mind, I've mentioned this in previous video breakdowns to be prepared and get ready for more market volatility. For example, I said in this previous post, and again, you guys can always check the dates of our posts. I said to you guys on the 5th of August, literally, if you go look at the charts right down here on Monday, the 5th of August, I gave you guys an entire PDF. You guys can go on my X profile, click this link, and it's a whole list of different digital assets that I was dollar cost averaging into, which are now currently all sitting in profit. I mentioned to you guys when the market was tanking, every crisis carries with it the seed of an equivalent opportunity. Food for thought, just some things to think about, right? Take into consideration what he just said. In my personal opinion, don't be too overly optimistic. Always have some capital on the sidelines in case we experience some more market downturns, which are a possibility. They're not guaranteed, but be prepared for them. Let's hope that that doesn't happen. Let's hope that we continuously see some upbeat, volatile price action to the upside and maybe possibly another blow off bull market cycle. But just in case there is another market downturn, be prepared to take advantage of opportunities because we are in the midst of a super cycle where every single time the market does see a significant downturn, we will see right after that a significant rise in valuations of these digital assets because these financial institutions know for a fact where this market is headed long term, and they will scoop up everybody's fear like they have in most recent times and continue to do so every single time the market drops. So again, what do you think you should be doing as a retail trader? I just thought that I'd share that with you guys. All these DCA levels that I put out to you guys publicly that were shared from our private CYPRX Discord are actually now currently in profit. And you can see here the date, August 5th, these were all put out to you guys at the exact bottom. Right? So just pay attention to detail. Now let's move on. Let's go back to this individual, Thomas Cohen. He talks about JP Morgan and he talks about the banks moving on chain. I want you to take into consideration something, a video breakdown that I played from a previous representative and an individual of JP Morgan discussing and talking about how they're building out the system in order for them to literally drag and drop and be able to integrate and migrate over to these public chains when the regulatory environment is clear enough and when they are ready. Take a second and listen.
And then, of course, I thought I would highlight as well that Galaxy actually recently tokenized a Stradivarius violin from 1708. We had a client come to us who talked about how the collateral that we were using before, Bitcoin, Ethereum, and other crypto assets, was quite volatile. And so he said, well, I have this violin, and by putting it on chain, it means that he can get a much higher TVL on the loans and the financing that we were offering him. So really, that's the idea is we see all these different assets, we see these different utilities, and what they really do is drive the narrative and make people think differently and make people think, okay, this doesn't happen in normal TradFi, so there must be something here. And that kind of gets us to the pilots and the proof of concepts, which to me is, I think these are earliest on, but at the end of the day will likely have the highest impacts. Because you see the Regulated Liability Network, Project Guardian, the KKR fund that was tokenized on Avalanche, and while they very much are in project and pilot mode, those final reports do catch the eyes of senior executives, and they do change the direction in the long term of capital allocation between these major firms. And I think we see that with, Onyx is a great example where Jamie Dimon is known to be a comparative critic of the space, yet Onyx has hundreds of people working at it because they recognize the power of the underlying technology and the way that it can be integrated into the space in a specifically advantageous way just for traditional financial products, let alone the future financial products that this technology enables.
Institutions who are experimenting in crypto. So, Tyron, if you could give us some history about and perspective of the transition from private institutional blockchains to maybe more public, or what you guys are using today. And Eric, I know you have really interesting opinions on where that's going to go in the future.
Yeah, and maybe I can just provide a little bit of context in terms of just the traditional financial services market and how we think about the requirements really to be able to operate a safe and sound system. So JP Morgan processes about $10 trillion of payments every day. That's 400 times the global stablecoin daily volume. The global FX market is about $5 trillion. And so when we think about utilizing blockchains as a settlement layer, we need the infrastructure to actually support these volumes, and we need them to support the scale that the traditional financial services market is at. So right now, clearly, there are a number of reasons, both technological-wise, but also regulatory-wise, as to why we have to use permissioned blockchains. However, you can think about these globally ever-present, always up, highly redundant public blockchains as a really, really attractive settlement layer that can service this global market. However, until we actually solve some of the key challenges, specifically around privacy, specifically around things like AML, KYC, it does become difficult for us to fully step into that environment. We did a project last year with the Monetary Authority of Singapore where we demonstrated what it would actually look like for a regulated institution like ourselves to utilize public DeFi protocols, to utilize public blockchains. And very clearly, there were lots of very insightful learnings for us. The transparency that you get around DeFi pools, for example, the ability to have anytime price discovery through a DeFi protocol, very, very important and interesting. Also, the lower cost. But as I said, until we actually have some clarity around the ability to actually operate on this infrastructure from a reg perspective, we're going to have to be in the sort of permission view until we can take some of the hybrid steps. And those hybrid steps look like some of the existing infrastructure that is coming out right now around subnets or permission zones or these kinds of things. And from our perspective, the reason why we operate an EVM sidechain is so that everything that we build can actually be portable into a public environment. So actually moving into the public blockchain environment when we can will be much of a sort of a lift and drop scenario.
Onyx is a great example where Jamie Dimon is known to be a comparative critic of the space, yet Onyx has hundreds of people working at it because they recognize the power of the underlying technology and the way that it can be integrated into the space in a specifically advantageous way just for traditional financial products, let alone the future financial products that this technology enables.
So again, hearing things like that, things that never reach the mainstream media, how could you be bearish on this digital asset space? These are reputable individuals that have many more credentials than myself and most likely you listening, individuals that used to work at the Federal Reserve, that currently work at JP Morgan, that are telling you all this stuff. Keep in mind, just a couple days ago, there was mass fear, uncertainty, and doubt being pumped on mainstream media platforms, shaking you out of the market, when in reality, these reputable individuals are on stage telling you all that that is not to be the case. Do not get distracted, ladies and gentlemen. I cannot stress enough. Now we're going to transition, and I'm going to play some more video clips of this individual representative talking about how in the near future, a large portion of the financial industry, again, TradFi, is going to be migrating over to DeFi and this new digital asset ecosystem. Keep in mind when he's talking how early we are. You have to understand right now we're sitting at $2 trillion in market valuation. Listen to what these representatives on stage talk about. All these financial institutions realizing that building on crypto rails is much more efficient, that the new financial system is going to migrate on chain. And even if it's just 20% of the financial system in TradFi comes on chain into this digital asset ecosystem, we are going to see an exponential growth curve that most people are not even going to be able to fathom. They're going to look back and they're going to call you lucky. Take a second and listen.
So I think one thing to note is, well, then what happens 5 years from now? Where will we end up? This most recent stat I thought was telling. 16 trillion, of course, is a big number. And I think the question becomes, how do we get there? If I were to give this presentation 5 years from now, I guess 6 years from now, would we really be able to get there? That's the question. I think we will. I think we'll it'll have ups and downs. It'll be sinusoidal, but it'll very quickly become exponential at some point. It'll have ups and downs. It'll be sinusoidal, but it'll very quickly become exponential at some point.
How big this market can get. So right now we said, tokenized real-world assets is around $200 billion, which is small. It's 7-8% of the overall crypto market versus, TradFi is much, much bigger. Equities, 100 trillion, real estate, 300 trillion, and we can disrupt all of these markets together. So let's assume, the crypto market will grow over the next 4 years from 2.5 trillion to 10 trillion, 4x. Are we still going to keep our market share as real-world assets on chain, 7 to 8%, or are we going to outgrow this?
Just take the entire financial system, all of it, all assets, equities, commodities, real estate, gold, all of it, and then assume there's another 10 or 20% of assets more that haven't been generated because it's very hard to turn them into an ownership receipt. So there's an additional 10 or 20% of new things, shares of a farm, shares of a solar panel operation, shares in restaurants, shares in owning a piece of real estate, carbon credits. So just take the whole thing and move around 10 or 20%, depending on the creation of more assets at the edges of the financial system.
Nice.
Yeah.
A big goddamn number.
Yeah, that's a big number. Thank you so much, guys.
We've made tremendous progress. I mean, we've seen to come from literally nothing just 4 years ago. But at the end of the day, 3 billion in the financial system is a rounding error. And so we've shown this growth and we have this potential, but truly we have so much left to go and so much green space, which is also why it's so exciting and why conferences like this are so key, because we're just getting started. And the question is, again, 5 years from now, whether this graph, we think it will be linear or whether it will be exponential. My belief is I think it will be exponential with some clear bumps in the road, but we will see. We'll see. What can we do as an industry today to make sure that vision is really brought forward into the 2020s instead of into the 2030s and beyond? And to me, these aren't rocket science, but I think a lot of the time, especially when we're talking with large traditional financial institutions, people talk about how this technology is truly revolutionary and can transform the way that we store and move and access value. And while that's true, what's important is to have the conversation be about how it's evolutionary, how we can help these large institutions make small steps every year over time so that a decade from now, they can look back and say, oh, wow, suddenly half of the financial transactions that we engage in are actually on chain, and they wouldn't even realize.
And so what is the value of DeFi today relative to what people perceive the value of DeFi might have been 3 years ago? Well, the value is that it's actually easier and faster and better to build financial products on a DeFi stack than it is to build it on the old traditional financial stack that was built over the last 50 years. And that's why you're seeing major banks, major PBs start to build things like tokenized money market funds. Because they see this and they say, oh, the crypto rails are actually better for trading these traditional assets than the current rails that we have. So we're going to move over slowly.
To that point that things may not be in the financial world, and the basis that 2 of the 4 panelists are from technology companies and not from financial companies. So I think tokenization is very much, you will see a shift away from the financial world in the TradFi kind of inverted commas, if you like, to be much more technology orientated.
So I mean, to go back to the original question of the panel, you think that, yeah, where does that answer sit in relation to the question of the panel, I suppose, when we're moving away from traditional finance?
Yeah, traditional finance will move towards crypto,
okay,
and not the other way around.
Okay.
A decade from now, they can look back and say, oh, wow, suddenly half of the financial transactions that we engage in are actually on chain, and they wouldn't even realize.
Last but not least, to full circle back to this post, financial institutions know for a fact, they know 110% where this digital asset ecosystem is headed in the near future. I cannot stress enough, ladies and gentlemen, now is not the time, even if we see another major market downturn, to be bearish on crypto. Sure, short term, does it suck that market prices and valuations drop significantly? Absolutely. I'm not denying that. Be ready for that and be able to stomach that market volatility. Have some capital on the sidelines to deploy in case we see further discounted opportunities. Not financial advice. That is what I'm doing. I've deployed some capital in this most recent market downturn, and I also have some capital on the sidelines just in case we see further devaluation so I can scoop up some more discounted prices. Understand the long term, zoom out, and see how massive this space is going to scale in the next 1 to 5 years. I know that that is a prolonged timeline, but again, the vast amount of individuals will not make it that far because they are so short-minded. They're so simple-minded. They're so zoomed in to the now, and they don't see the bigger picture. When you zoom out and you understand that all these financial institutions have a 5-year plan, a 10-year plan, a 15-year plan, you will also start to accumulate one yourselves. As always, many blessings to you guys, bringing you guys the realist research and information. Shout out to the CYPRX researchers. Shout out to all the followers that have been consistent watching the CYPRX YouTube platform. We do appreciate the love and the support. Share these video breakdowns, like, subscribe. As always, be cognizant, be aware out there, and I'll see you all in the next video breakdown.